Welcome to our YouTube channel. Today we dive deep into the world of real estate investment trusts, or REITs for short. Now you might be wondering, what exactly are REITs? Well, in the simplest terms, they're companies that own, operate, or finance income-producing real estate across a range of property sectors. These sectors can include everything from shopping malls to data centers, and from apartments to hospitals. The diversity of REITs offers investors a way to gain exposure to real estate without the need to directly own properties. One of the unique aspects of REITs is the way they're structured. To qualify as a REIT, a company must comply with certain Internal Revenue Service regulations. For instance, they must invest at least 75% of their assets in real estate, cash, or U.S. Treasuries. They must also derive at least 75% of their gross income from rents, interest on mortgages that finance real property, or from sales of real estate. But what does this mean for you as an investor? Well, one of the main benefits of investing in REITs is the potential for income. You see, because of their unique structure, REITs are required to distribute at least 90% of their taxable income to shareholders annually. This means that investors can often expect a steady income stream from their REIT investments. Another advantage of REITs is the ability to diversify your portfolio. Because REITs can be found in numerous sectors of the real estate market, they can add a level of diversification that can be hard to achieve with other types of investments. And lastly, REITs offer the potential for long-term capital appreciation. As properties increase in value, so too does the value of the REIT, which can result in higher share prices over time. Understanding what REITs are is an essential step in identifying undervalued ones. So, buckle up as we move to the next step. Enjoying this content? Don't miss out on future videos filled with even more tips, tricks, and inspiration. Hit that subscribe button now to stay tuned with us. Now that you understand the concept of REITs, you might be wondering, why should you consider investing in them? Well, there are a few compelling reasons. Firstly, REITs can provide a regular income stream. They are required by law to distribute a minimum of 90% of their taxable income to shareholders annually in the form of dividends. This makes them particularly attractive for income-focused investors. Secondly, there's potential for capital appreciation. Just as with other types of investments, the value of REITs can increase over time, offering the possibility of selling shares at a profit. Finally, REITs offer a great means to diversify your investment portfolio. They represent a different type of asset class that's not directly correlated with the stock market. This can help to spread risk and potentially enhance overall returns. With these benefits in mind, let's move on to how to identify undervalued REITs. Identifying undervalued REITs involves a bit of financial detective work, but don't worry, we will guide you through it. Let's start by understanding what an undervalued REIT actually is. Imagine walking into a store and finding a high-quality product selling for less than it's worth. That's an undervalued REIT in a nutshell, a real estate investment trust whose current market price is less than its intrinsic value. So how do you find these hidden gems? Well, there are three key financial metrics that can help you in your search: the price-to-earnings ratio, dividend yield, and net asset value. Firstly, the price-to-earnings ratio, or PE ratio, is a valuation ratio calculated by dividing the market price per share by the earnings per share. A lower PE ratio could suggest that the REIT is undervalued. However, it's important to compare the PE ratio of the REIT with the average PE ratio of the sector. This will give you a more accurate picture of whether the REIT is undervalued or not. Next, we have the dividend yield. This is the annual dividend payment divided by the market price per share. A higher dividend yield may indicate an undervalued REIT, but remember, a high dividend yield can also be a result of a falling market price, so always cross-verify with other metrics. Finally, there's the net asset value, or NAV. This is the value of the REIT's property assets minus its liabilities. By comparing the market price per share with the NAV per share, you can determine if a REIT is undervalued. If the market price is less than the NAV, it could indicate that the REIT is undervalued. Now, these are just guidelines. No single metric should be used in isolation. It's like trying to paint a picture with just one color. You won't get the full image. You need to look at all these metrics together, along with other factors such as the REIT's management, the quality of their properties, and the health of the overall real estate market. Furthermore, Remember that real estate market is influenced by a multitude of factors including interest rates, economic growth, and demographic trends. So it's essential to keep an eye on these macroeconomic indicators as well. Remember, the goal here is not to find the cheapest REITs, but to find quality REITs that are trading for less than their worth. Armed with this knowledge, you can now identify undervalued REITs. Next, we will discuss how to invest in them. Now that you know how to identify undervalued REITs, how do you go about investing in them? It's a great question and one we're about to dive into. First things first, you'll need to open a brokerage account. This account is your gateway to the stock market, and it's where you'll purchase your shares of REITs. There are plenty of online brokers out there, so choose one that suits your needs and preferences. Look for low fees, good customer service, and an easy-to-use platform. Once your account is up and running, it's time to do a little homework. Remember, not all REITs are created equal. Some invest in commercial properties, some in residential, and others in a mix. Each REIT has its own risk and reward profile, and it's up to you to decide which one aligns with your investment goals. Start by researching different REITs. Look at their property portfolios, their dividend histories, and their management teams. Don't forget to check out their financials too. You want a REIT that's financially sound and capable of weathering economic storms. When you've found a REIT that looks promising, it's time to buy some shares. This is as simple as logging into your brokerage account, entering the ticker symbol for the REIT, and clicking buy. But remember, investing isn't about making a quick buck. It's about long-term growth and steady returns. So don't get spooked by short-term market fluctuations. Keep your eyes on the prize and remember why you invested in the first place. Finally, hold on to your shares for the long term. REITs are designed to provide steady, reliable income through dividends, and the real value comes from holding onto your shares and letting those dividends accumulate over time. Don't be tempted to sell at the first sign of trouble. Instead, be patient, stay the course, and let your investment do its work. Investing in REITs is a process that requires patience and diligence, but the rewards can be well worth it. So take your time, do your homework, and make your move when you're ready. The world of REIT investing awaits. We hope this video has given you valuable insights into the world of REITs. It's been an exciting journey, hasn't it? We've explored the concept of REITs, understood the reasons why they can be a lucrative investment opportunity, and even delved into the process of identifying and investing in undervalued ones. Let's take a moment to recap what we've learned. REITs, or real estate investment trusts, allow you to invest in real estate without the need for direct property ownership. They offer the potential for income through dividends and the chance for capital appreciation. We've also discussed how to spot undervalued REITs, looking at factors like their price-to-earnings ratio, dividend yield, and the quality of their real estate assets. Remember, this video is just a starting point. It's essential to conduct your own research before making any investment decisions. Look at the fundamentals, the market conditions, and the overall financial health of the REIT. Understand the risks involved and consider whether the investment aligns with your financial goals and risk tolerance. If you're new to the world of REITs, don't rush. Take your time to learn, understand, and make informed decisions. The world of investing is not a race, but a journey. And on this journey, knowledge is your best companion. If you found this video helpful, please subscribe to our channel, like this video, and share it with others. Your support helps us create more content like this. We're here to provide you with the knowledge and tools to make informed investment decisions. And remember, the world of investing is at your fingertips. You have the power to shape your financial future. So go ahead, dive deep, learn more, and take the first step towards your investment journey. Always remember, knowledge is power, and you are just a click away from unlocking it. If you found this video helpful, please subscribe to our channel, like this video, and share it with others. Your support helps us create more content like this. Remember, the world of investing is at your fingertips.